Hi learners, welcome once again to Curious Commerce. Today we are starting a very important and specialized area in financial management. The title is Sources of Finance. Before entering into definitions and classifications, let us clearly understand the idea of this chapter. This chapter explains how a business raises money. It also explains why different sources are used for different purpose. Every business activity requires money, whether it is starting a business, running a business, or expanding a business. Finance is essential. That is why finance is called the lifeblood of business. In real life, many businesses fail not because of lack of ideas, but because of lack of finance. Therefore, understanding sources of finance is important not only for our regular examinations but also for practical business decisions. During the study, we will study long term sources, medium term sources, and short term sources of finance. We will also understand the advantages, disadvantages, and suitabilities of each sources of finance. Introduction to financial needs. Every business requires finance at different stages of its life. Finance is required even before the business actually starts. It is required during the operations of the business. It is also required when the business wants to grow or expand. The amount of finance required differs from one business to another. A small retail shop needs less finance. A large manufacturing company needs a huge amount of finance. Financial needs depend on factors such as nature of business, size of business, and stage of business. It means that the business life cycle, it is in the growth stage, or it is in the maturity, or it is in the decline. For example, a service business or service industry needs less fixed capital compared to a manufacturing business. Therefore, before selecting the sources of finance, it is necessary to understand the financial needs of the business. The first need is the fixed capital needs. Fixed capital refers to money invested in permanent assets of the business. These assets are used for a long period of time. They are not meant for resale in the ordinary courses of business. For examples, for fixed assets include land, building, plant and machinery, furniture, vehicles, etc. These assets help the business to produce goods or provide service. For example, when a company starts a steel plant, it needs land for the factory building and heavy machinery. The money invested for purchasing these assets is called fixed capital. Fixed capital remains blocked in the business for many years. It cannot be easily converted into cash, or the liquidity nature is very less. Because of this long term nature, fixed capital needs are generally financed by long term sources of finance. The second one is the working capital needs. Working capital refers to the funds required for day to day business operations. It is required to keep the business running smoothly. Working capital is used for purchasing raw materials. It is also used for paying wages and salaries for the laborers or employees. It is required for meeting expenses such as rent, electricity, water, and transportation. Unlike fixed capital, working capital is constantly circulating in the business. Money is used to buy goods. Goods are sold and converted back into cash. For example, a grocery shop needs money every day to buy goods from the wholesaler. This daily requirement of funds is called working capital. Even a profitable business may fail if it does not have sufficient working capital. Therefore, managing working capital is very important. Third one is growth and diversification needs. The capital required for expansion of the existing plant or the existing product line or the expand related to the logistics or purely diversified field. For example, the ITC, they are diversified from the tobacco products to general grocery items. For the type of the situations, the finance is very essential. The fourth one is asset maintenance. In the case of the asset maintenance, replacement of depreciated assets should be considered. We calculate the depreciated values of the each and every assets with the proper time manner. We should replace it. Otherwise, we called as the non-performing assets. That's why the asset maintenance is also very important for the decision making purpose. Classification of sources of finance. After understanding the financial needs, the next step is to understand sources of finance. Sources of finance are classified to make decisions making easy. Classification helps for management to select the right source at the right time. If sources are not classified, confusion may arise. Wrong selection of sources may increase cost and risk. Therefore, classification is very important in financial management. Sources of finance are generally classified on three bases. There are classifications by period, classifications by ownership, and classification by generation. Each classification has its own significance. We will discuss one by one. Classification by period. Classification by period means classification based on time duration. Different business needs require finance for different periods. Long term sources are required for a longer duration. Usually, they are required for more than 5 to 7 years. They are mainly used for acquire new fixed assets. Medium term sources are required for a moderate period. Generally, they are required for 3 to 5 years. They are used for expansion of existing business, replacement of the machinery, and modernization or upgradation of the technology. Short term sources are required for a very shorter duration. Usually, they are required for less than 1 year. They are mainly used for working capital needs. According to the matching principle, long term needs should be financed by long term sources. Similarly, short term needs should be financed by short term sources. The second classification is classification by ownership. Classification by ownership shows who provides finance to the business. It explains whether the provider becomes an owner or a creditor. Once again, I will repeat. It explains whether the provider becomes an owner or a creditor. Ownership capital represents ownership in the business. Equity shares and preference shares come under ownership capital. The providers of this capital are called shareholders. Borrowed capital represents borrowed fund. Debentures and loans come under borrowed capital. The providers of this capital are called creditors. Ownership capital involves higher risk. However, it also provides higher return. Borrowed capital involves lesser risk. It provides fixed return in the form of interest. The last classification by generation. Classification by generation explains the sources of origin of funds. It shows whether funds are generated within the business or from outside. Internal sources are generated from within the business. The main internal sources of finance is retained earnings. These funds belong to the business itself. External sources are raised from outside parties. They include public issues, banks or commercial banks, and other financial institutions. Young and growing companies depend more on external sources. Mature and stable companies depend more on internal sources. We will discuss the long term sources of finance in part second. Thank you all for daily updates. Follow Curious Commerce Financial Management Hub in WhatsApp channel. Please share and subscribe for upcoming videos. The long-term source of finance will be continued in part second. Thank you all.